share with you a resource that I put together over the weekend and really like the way that it came out. It's going to be under insight and statistics. It's going to be under affordability, and it's going to be pages 2 through 6 or so under affordability. So let me show you. So this is the affordability section of Insight in Statistics, and you can see blue is going to be the median sold price, and then you've got this color line that's going to be the average rate. And you can see that, of course, rates have gone up quite a bit since 2020. So let me walk you through this resource right here. Very important for us to realize what's happened with pricing and what possibly may happen moving forward. So we talk a lot about the Federal Reserve initiating a mortgage-backed security purchase plan starting back in January of 2009. You've heard me say this 1,000 times over, that from when the Fed was created in 1913, and if you want to read all about the creation of the Fed, you can order and buy a book called The Creature from Jekyll Island. It's a dense read, 500, maybe 600 pages, but it is well worth the read. Buy that book, read 5 pages a day. 5 pages a day, 100 days from now, only 3.5 months from now, you know the entire establishment of the Federal Reserve. It is a phenomenal book. If you're not a reader, get it in Audible. I love Audible. I've got an Audible account. I absolutely love it. Just do 5 pages a day and you will know more than 99% of the people out there. So in January of 2009, and we've got a little cheat sheet right here, the Federal Reserve initiated mortgage-backed security purchase. And prior to that, they never did that. So I was in real estate back when they did that. We all in the industry rejoiced because rates were going up. No one was buying. And we had a huge, what's called a liquidity crisis in mortgage-backed securities. It was toxic. It was a toxic asset no one wanted. So the issue wasn't even that buyers didn't qualify for that higher rate. You just couldn't get a mortgage. It was very tough to get a mortgage. Well-qualified buyers were being denied. Fed steps in and they say, you know what, we're going to buy mortgage-backed security. That right there happened January of 2009. Now this gray line, that's interest rates. So you can see that rates were, between 5 and 7%. And then they announced December of 2008 that they're going to be purchasing mortgage-backed securities. When they start doing that, it immediately drops down to 5.12%. Well, why is that? Because when you have the Federal Reserve, unlimited money, they can print as much money as they want. They can just hit zeros on a keyboard and create unlimited money. They can do whatever they want. And they start purchasing an asset. Well, think about Austin real estate 2 years ago. You had investors, BlackRock, Citadel. You've got Open Door. You've got all of these companies purchasing Austin real estate, and even regular homeowners like you and I, our clients, purchasing real estate. More buyers purchasing an asset will do what? Well, it increased the value of that asset. Therefore, the yield of that asset will go down. You will have a lower return on investment if you were to rent that asset because the price goes up. Same thing happens with mortgages. As the mortgage-backed security price, it starts at $100. That is called PAR, P-A-R. It starts at $100, and as more bidders bid for that price, that asset, the price goes up. Now, there's a fixed return on investment for that asset. That's the rate. So if you purchase a 5.5% mortgage-backed security, meaning it's going to yield 5.5% every year, and you pay $100, well, that's your return. $100, 5.5%. If there are more bidders bidding for that mortgage-backed security, the price of that mortgage-backed security goes up. Well, now people are bidding $102, $103, $105. Well, your effective yield goes down. Your rate goes down. That is what happens. That's how mortgages are created. That's how rates work. And as you can see, as the Federal Reserve started purchasing mortgage-backed securities, what happened with rates expressed in the gray line? Well, of course, it goes down. Well, then from 2012 roughly to 2018, 19, the Fed put a stop to that. They're like, okay, we've fixed the mortgage market. We fixed everything. And then, of course, we all know what happened in 2020. Fed initiates another round of mortgage-backed security purchase, and rates go all the way down to a record low 2.5, 2.25, 2.75. Now that we know the gray line, now let's take a look at the orange line. This is what the orange line is. The orange line is the January 2000 price, the January 2000 average sold price in our market. And we then add the month over month CPI, Consumer Price Index. So as inflation does what? Inflation adds money to the economy, and therefore, right, you have more money chasing after limited goods. What happens to the price of goods? Well, it goes up. So this is a fixed point in time, January of 2000, and then every month you add the inflation, 1%, 2%, 0.2, 0.1, negative 0.1. And you can see this is what prices would be like apart from anything other than inflation. That's what that is. So this is what this means. When you look at the inflation adjusted price, it's roughly at about $375,000 right now, meaning $375 September of 2023 has exactly the same buying power as roughly $170,000. So our dollar has eroded by this level simply due to inflation. That's what this means. That's what this orange line means. Okay, that's just the value of your dollar being eroded through inflation. Now, something very interesting happens right here. The blue line is the average sold price, the market. What sold in January, February, March, April, 2000, 2001, 2003, all the way to 2023. That is the average sold price. Now, you're going to notice something really interesting, which is, do you see the correlation right here? Isn't that fascinating? That over history, and we can go all the way back to 1903, we can go all the way back to 1850, over the course of history, home prices appreciated at roughly 3 to 3.5% a year. Slightly over inflation. Real estate was a very stable asset, and it appreciated slightly over inflation, and you can see that. This is the home price, and then it kind of adjusts back down to inflation. It goes up, it adjusts back down, up, adjusts back down, up, adjusts back down. And then we've got the Great Financial Crisis, right? The GFE, the Great Financial Economic Crisis. And it adjusted back down as the market corrected. Up a little bit, adjust back down. Now, everything changed between May of 2022, between January 2009 to May of 2022. This is the start and the finish for when the Fed started buying mortgage-backed securities. And you can see that it created a huge gap, a huge divide. The accessibility and availability of lower interest, of cheap money, allowed the prices to go up, because what stayed the same was the amount of money that people could contribute towards their mortgage. Like, hey, I want a $2,000 mortgage payment. I want a $3,000, $4,000. For the most part, that stayed the same. That just kept up with inflation. Wage growth, up until recently, has kept up with inflation. Over the past 2 years, unfortunately, it has not. There's a gap in that. But when money became cheap, when interest rates went down, the divide between the real price and the inflation adjusted price started going up and up and up.